Hey guys, it is Seth and Paul. Welcome back to Everything Money. We are lucky enough to have Tobias Carlisle on an interview today. He is the author of The Acquirers Multiple. Now this title, Tobias, how the billionaire contrarians, Paul, we like this word contrarians, of deep value beat the market. I'm eager to learn what deep is, Tobias, because I just thought value investing was strange and kind of weird. And now we're going really deep into this, so I'm eager. But welcome to the show. Thanks for coming on. We're happy to have you.
Thanks for the very kind introduction, gents. Nice to meet you both.
If you guys want to know more about Tobias moving forward, you can just look him up. He's all over YouTube. Tobias, your podcast is called The Acquirers Multiple Podcasts, and you have guests in as well?
The Acquirers Podcast, yeah.
The Acquirers Podcast, yep.
Well, I had two I had one that was an interview style where I talked to other money managers and just sort of asked them about their process. It just became too much. So I have another one where basically I chat with two friends of mine who are investors and we just talk about what's happening in the markets. We call that value after hours. The idea is it's like, these are the conversations that we would have in a bar at a conference or after the market closes. So it's casual and it's sort of the stuff that we really think about.
Yeah, I can see how these podcasts turn into new things. This used to be a cooking show. So, but anyway, Paul, you really so you got this interview. You know, I've emailed some greats in this world. We've talked to Jerry Parker from the Turtle Trader. We've interviewed Manesh Babrai. You mustered up the courage to email Tobias. Why did you do that? Why are you interested in?
Well, you motivated me, Seth. So I got this book. So Tobias, we have a great community. We have over 6,000 people who have our software, have our community. And everybody kept saying to me, hey, Paul, have you heard of The Acquirers Multiple? I said, yeah, I'd heard about it, but I never read your book. But when I say 10 or 15 people in a matter of a month asked me about this, and we had 1,000 people, I was like, okay, let me check this out. So I got it. And I liked it. I thought to myself, okay, this is another version of Joel Greenblatt's a little book that beats the market. So I read it, and you know, there are a lot of things that made sense to me about how to look at the fundamentals of the business. So I guess from my standpoint, first things first, how did this whole thing come about? Because, you know, you're young, like, how old are you, Tobias?
I'm 42.
Okay, so we were saying the same thing. Yeah. We're 40. And I was like, okay, this guy's pretty young for somebody who understands this kind of stuff. So not to get into a generic question, but how did this whole thing even begin? And what'd you do? Like, how did it all happen?
So I started out as an attorney. I was a corporate advisory lawyer, which is doing mergers and acquisitions or any sort of corporate stuff, that raising capital, buying other companies, you know, working for private equity, working for activists, doing various different things. I started in April 2000, which was the absolute top of the stock market in Australia. I'm Australian, and but you know, it's the same. It's the same kind of market. It was very much like what we've just gone through now, where it had been a very techie market. There are lots of people who wanted to be VCs or,
of course,
tech type guys. And I sort of, from my first day, I thought what we're going to be doing is a whole lot of venture capital type investment, helping big funds invest in new companies. And it just so happened that all just sort of disappeared when the market crashed. And what ended up happening was we did a lot of the other side of that, which is, you know, pulling these companies apart, doing liquidations. And there was this new kind of style of investor who appeared, who we didn't call them shareholder activists at the time. I thought that they were like, a lot of these guys were, you know, raiders from the 80s who had come back.
Yeah.
And who were buying these companies that had terrible cash burn, but a whole lot of cash on the balance sheet because they just had a big IPO, big capital raising. And so, you know, they might have $50 million in cash, but they're burning like 25 million. Could be a quarter, you know, and their business models were, they were losing money on every sale. That sounds like it's not true at all, but that's actually the case. Like many of them were that's how they were getting market share. And it just looked to me like I had enough. A friend of mine had said Warren Buffett is the richest man in the world, and he owns an insurance company. And I just had thought to myself, well, who cares about insurance? Like I have no interest in that. And he pointed me to the investor letters that Buffett has written, and I read through those letters, and it did become clear to me that it was at least a logical approach to investing in the stock market. You know, it's not really stock market investing. You're sort of looking at an underlying valuation and then working out whether you can sort of generate some reasonable returns after looking at that underlying valuation. So I looked at these things and I thought, how can anybody be investing in these? And then what I realized was these guys would would get control, just stop the business. And so there goes the cash burn. And now you have a pile of cash that you can invest in another company. They can do like a daisy chain of these things. And that's what some of these guys did. They'd buy a string of these listed companies, or they'd just liquidate it and pay out the cash. And I thought, if that scenario, I recognized that was an unusual scenario where, it probably only happens once every 7 or 10 years. And I thought, if that ever happens again, I will go out and I'll invest in some of these kind of companies. And then, of course, 2007, 8, 9 rolls around. I'd been practicing law for 7 or 8 or 9 years by that point. I was reasonably senior. I'd been working in the US doing tech M&A. I'd gone back to Australia to be general counsel of a company listed in Australia that was a dark fiber telecommunications infrastructure company. So they had a peering exchange, dark fiber, which is sort of unlit. You take the whole fiber, or you take a wave on the fiber, and they had a subsea cable and doing lots of interesting things. Got sold, market had crashed, and so I was in this position where I had some money and I had that opportunity to do something. So I went and started working for an activist, and I didn't want to conflict with anything that he was doing in Australia. This was an Australian-based activist, and so I started investing in the US and writing about it on a little website called Greenbacked, just a little blog. And I was basically looking for nets, sub-liquidation value things where there was an activist involved. I did that successfully through sort of 2008, and I was hard to miss through that period of time if you were in those kind of companies. But then I realized that portion of the market really only becomes investable when you have a big crash. And then outside of that big crash, you have to have some other investment strategy. And I like the idea that you're doing a lot of balance sheet assessment, and you're not relying so much on the performance of the business, because many businesses aren't great. You're sort of just trying to get you're trying to get the free optionality in the business when you're buying these things based on the balance sheet, and you're selling them based on the recovery in the business. So the one simple way of doing that is this, what I call the acquirer's multiple. And the big distinction between it and the magic formula, which I'm sure we'll come to, is just the treatment of the magic formula has 2 very simple inputs. One is the sort of operating income, or EBIT, versus the enterprise value, which is, we can unpack all of that in a moment too. And then there's this quality metric, which is how much the business earns on its assets or on its invested capital. And so I had, for a variety of research, and this was my own bias probably at the time, but I was aware of some research that said that if you use that return on invested capital metric, you sort of stunt your returns that you would otherwise get just from using the value returns.
You would stunt your returns?
Yeah, the returns are lower using the quality metric.
Okay.
And so I've tested that in countless different stock markets globally. I've tested that in Australia. I've tested that in the US. That seems to be, it's a pretty robust finding that the quality metric actually detracts from your returns. Other than in this very small portion of the market, about 4% of the market, that has these sustainable high returns on invested capital. Most of the time when you're buying these companies using the return on invested capital, what you're doing is you're buying stuff that's closer to the top of its business cycle, and you sort of suffer as a result. When you're buying things that are very cheap on an EBIT, EV, the value metric basis, what you're doing is you're getting things that are closer to the bottom of their business cycle. And so you enjoy the mean reversion in the underlying business as well as the...
Let me interrupt real quick, because I want to make sure everybody's watching understands. When he's saying EBIT to enterprise value, Tobias, why don't you explain? So EBIT is earnings before interest and taxes. Now, most people understand EBITDA, which also adds back in, which also takes out depreciation. But as real investors know, depreciation is a real cost, because free cash flows after capital expenditures that get depreciated. So it is a real cost of the business. And a lot of people miss that. And a lot of acquirers out there go, we buy 4 or 5 times EBITDA. And I'm like, oh, so if a company spends all of its operating cash flow on CapEx, they're completely ignoring that completely, even though it's a true cost of the business, a high, as Warren Buffett calls it, a capital intensive business.
Right. So we've tested, I'm much less quantitative now than I was, but I view it as doing a little bit of a research. So I wrote a book called Quantitative Value that came out in 2012 with a guy who was doing his PhD at the Booth School of Business, which is sort of widely regarded as the best quant school. It's the old Chicago School of Business. I probably don't have to say that anymore. I've been saying that for a long time, but I think probably most people know it as Booth these days. But the idea is that we just went and tested every bit of industry and academic research that we could find about fundamental investment, going back as far as we could find it. So that included stuff that Benjamin Graham had done, stuff that guys had done around that period of time, like Altman Z, like things that Altman Z, when it was first invented, it was for manufacturing companies, and that you can have a look at I've had a look at the old paper. Like I like to go back and get the original paper of these things, and so I've done it for a lot of different things, including the Kelly criterion, which we should talk about in a little bit too. But you go back and you look at these papers, and they've got these. What they've done is a linear regression of companies that have gone bankrupt to find out what financial statement ratios they can determine that sort of indicate this risk of bankruptcy. And so what they find is that there's these weird coefficients. If you ever do a linear, I don't know if anybody remembers doing this. I've done a few of them from when I was at university, but you basically do a linear regression. They come out with these weird coefficients like 0.27 times, days inventory outstanding or something, some weird thing like that. Why is that coefficient there? That's an artifact of a linear regression, and that will probably change over time. It may indicate that one thing is more important than another, but it's probably unlikely that they're exactly right in that ratio. So I think that sort of intuition about all of these studies should hold true, that probably the relationships remain probably the way that they are, but the coefficient to the decimal point is probably meaningless. And the reason that I raise that is that these things have changed over time. So we tested these old papers and we looked at them in the current, the book came out in 2012. So it's research to that point. And basically what we were looking for is, how do you determine if a company is credit worthy? How do you determine if a company has a good, high quality business? How do you know if it's undervalued? All of these sort of fundamental ideas that have been discussed in various research papers. So another really good one is accruals. If you have some unusual stuff going on in a business, you may accrue an asset where there's a mismatch between your accounting earnings and your actual cash flow. And so often you see this in frauds, that the accrual blows out. There's some weird asset that accrues on the balance sheet in order to balance out the differential between what the company is earning on an accounting basis and what it's earning on a cash basis.
So really quick to interrupt, and this pertains to a lot of people. When we do our videos, I always tell people over long periods of time, earnings and cash flow should be very similar. So one of the things to do is whenever you see big discrepancies over long periods of time, it should be a red flag of saying, why is that? So if the earnings, are $1 billion a year and the cash flows are $100 million a year over a 10-year period, and I'm doing an extreme example, you should say, wait, what's going on here? The biggest extreme of it is Enron. That was a big red flag for Enron. Enron was booking out profit years and years in advance and basically determining their own profit, yet the cash flows were literally a few percentage points of that actual earnings. And that was a big red flag for it. So to apply that to today, yeah.
Exactly right. Great example. So that's the sort of stuff that in all of that research that we did informs the way that I invest. And there's nothing, I'm not doing anything unusual relative to what other investors are doing. I just have this very simple, straightforward sort of approach to valuation, which we're looking for a clean bill of health on the balance sheet. We're making sure that the business is actually turning those accounting earnings into cash flow. And then I like EBIT because it does, it's not real. In most growing businesses, CapEx, capital expenditure should be higher than depreciation and amortization. So you can use EBITDA where it adds it all back in, but I think it's giving you a slightly misleading view of what the true economic earning power of that business is. you might say, well, why not use net profit then? Why not go all the way to the bottom line? The reason is that the capital structure, which is the amount of the mix of debt and equity that a company has, impacts, if you pay interest that's tax deductible, that impacts your tax. So you want to get an apples to apples view of what a business is doing, ignoring the capital structure.
So let's and by the way, Tobias, I'm sorry to interrupt you, but I'm thinking to myself, if I'm the average listener here, I'm like, wait, what's this guy saying? So guys, to break this down very simply,
please do.
He wants to take out the debt of the company. And the reason being is if you have two companies that are exactly alike.
This is Joe Greenblatt or Tobias?
This is Tobias. If you have two companies that are exactly alike, they both generate $1 billion in revenue. They both generate $200 million in profit before interest and taxes. If one has $10 billion in debt and one has zero debt, their bottom lines are going to look astronomically different when fundamentally their business operations are the same. So that is what Tobias is trying to differentiate here. He's trying to strip out, like, let me see the actual business. What's the actual business doing? Is the business actually, what is it doing before all the debts put onto it and all that stuff? Like recently, today, Broadcom announced they're buying VMware. They said there specifically, we are taking over their $8 billion in debt. Okay, that's a part of the acquisition. So if let's say they decided to pay it all off and not have any debt, these things affect the bottom line of the business. And that's when he said, hey, why not look at the net profit? Well, because if there's a lot of debt in the company, it's going to affect the net profit. If there's very little debt, it's going to affect the net profit. So he wants an apples to apples comparison between two businesses. Is that accurate, Tobias?
Yeah, Tobias, is this one of the things that I think you were claiming in the book that the magic formula is missing out on? I was explaining this to my wife because, Tobias, I've been invested in the magic formula, the little book stocks for the last 2 years. So when you explain to someone as simple as like my wife who doesn't know any of this, what the difference is between this and the acquirer's multiple, which folks at home, basically the multiple is he's coming up with a physical multiple to rank companies. So the acquirer's multiple is a low number that you want to get these companies. So yeah, if you can drill home, Tobias, the difference of what the magic formula, in your opinion, is missing out on, because I know in the book you claim that through this research, you get a better return over many years. It's upwards of 18.5% versus the magic formula is 14 or 15. So yeah, maybe get into some of that, because as a normal sort of a guy bringing questions, I'd love to hear sort of your comments on that.
Well, they're both very good. They're both very good metrics. I don't want to pretend. I think that the magic formula is a very good approach to investing. There's nothing wrong with that approach. I'm just a little bit kind of nitpicking the edge of it, where I'm saying that you can get a little bit better performance, but there is a trade-off. There's nothing that comes for free in investing, and the trade-off with going very deep value is that you can have long periods of underperformance, and the advantage of having that quality metric in with the magic formula is that it sort of keeps you up with the market through a period of time like we've just gone through, where it's more of a high growth tech profitability market, and that's been a very, very extended period of time. So it's been tough to follow the very strict deep value approach, and you'll notice that it puts you into heavier industries. You'll be in like a lot of energy and a lot of mining, and you're in these lower grade, and you're not going to be in any of the really sexy tech stuff. Like that you're going to miss out on a lot of that stuff. So the reason though, the intuition, the reason that you're going to be in these, the reason that you want to be in sort of avoiding these particular types of companies, sometimes what the magic formula does is, if you're looking at that high return on invested capital, what it's doing is it's pushing you into the stuff that's closer to the top of its business cycle. So most businesses, and statistically, it's about 96%. So it really is most businesses. There's about 4% that have this unusually high sustained return on invested capital, regardless of the business cycle. Most businesses have a business cycle. What that means is that there are parts of the cycle where they don't earn enough on their assets and they look like they're not very good businesses. And there are parts of the cycle where they over-earn on their assets, and taken together through a full cycle, they might earn an appropriate amount on their assets. But because this is what we want, we need the assets to justify their existence. We need these businesses to justify their existence. And if they don't, we'll redirect that capital to other places. The problem with the requirement that you have this high return on invested capital is it's pushing you into stuff that is closer to the top of its business cycle than at the bottom of its business cycle. And so you're just getting this slightly, where ideally what you want to be is really contrarian. So you want to be in the stuff that's not earning and is cheap, because at some point that will start earning again. And we've had a really good example of it with energy recently. Energy last year was, negative $37 oil. It's hard for energy to make money. They're just not going to make money at that level. And so you would look at that and you would say, well, this is not a good business to be in. But if you think about it through a full cycle, of course, we're going to go back to $100 oil. I'll give you for the rest of my life, energy will be too cheap and too expensive. It will under-earn and it will over-earn. And you want to be in it when it's under-earning and probably out of it when it's over-earning. And that's difficult to sort of to deduce when you're using a return on invested capital metric, because it's pushing you into it when it's over-earning and taking you out of it when it's under-earning. Having said that,
explain that real quick to our user. The reason is the return on invested capital is backward looking. So it's the most immediate, okay, well, last year it did really, really well. Well, in Tobias's view, it's, well, okay, but we're probably at the wrong end of the cycle. That's what he means by that you're getting into them at the end of the cycle. When the high return on invested capital, it's probably towards the time when it's like, hey, maybe they shouldn't be doing this well because historically they tend to go lower. That is Tobias's point when he talks about towards the end of the cycle.
Yeah. So I'm a huge fan of the magic formula. I don't want to criticize the magic formula. I'm a huge fan of Joel Greenblatt's. I'm a huge fan of the magic formula. It is very good intuition for the way that you should invest most of the time. It's just that you can get this, if you're prepared to put up with more volatility, you can get slightly better returns by sort of doing away with that quality metric. Having said that, there's a lot of good reasons to include that quality metric. It will just put you into slightly better companies. Your ride is a little bit smoother. You might not have as many years of underperformance. Those are real considerations. And I think that when you're going into these things, you should be eyes wide open and know exactly what your trade-off is. And for many people to say, I'm going to underperform the stock market for 5 years. And that's easy to say, but when you're 4 years into it with no prospect of like outperforming, it's hard to stick with it. And not everybody has that sort of mental fortitude to do it. Yeah, I commend you, Matt. It's exceptionally difficult to do. I have these. My wife is just like, why don't you go and buy some of this stuff that's working?
Of course.
It's funny, Tobias. You've never seen our show, I'm assuming, and that's fine. Join the other 2 billion people haven't, but. I revel in it. I love the fact that I've underperformed for 5 years. I just look at it and say to we joke and say the next 10 years are going to be absolutely glorious for us. Like I was very blessed with having zero FOMO. I literally, my example I always give Tobias is, if everybody told me the sky was blue, I just assume they're wrong, because that's how I view the world. I view the world as if everybody believes something, it's probably incorrect in some fashion. And that doesn't literally mean I think the sky is, orange. What I mean is that the masses tend to be wrong. So use that to your advantage. And then when stocks keep going up, I literally have zero. My brother will come in my office and saying, up again. I'll be like, yeah, it's up again. What do you want to do? And he's just like, are you serious? I'm like, yeah. And I'm very, very fortunate. It's zero phasing whatsoever. It's funny because there's some other people on YouTube who go, this idiot brags about being, having like very little returns over the last 5 years. Yep. Just zero qualms about it. But, and that's the thing, folks. Tobias sitting there saying, like, you don't want to be wrong for 4 or 5 years. It sucked. Don't get me wrong, Tobias, but it didn't faze me. I was just like, okay, I'll be right for the next 60. I'm okay.
Well, I'm actually being a little bit generous to myself. If I look at when I started underperforming, I really started underperforming about mid-2010, if I'm being perfectly honest.
Wow.
The returns have been sort of sufficiently good. The returns have been low teens for a really long period of time. And in any other kind of market, you'd say to somebody, I've had low teens for a few years. They'd say, good for you. You're doing really well. It's just that you can look and see that, the SPY, which is, basically you can buy that for basis points. And that's done really, really well. And when I look at the SPY, that this is the S&P 500, when I look at the S&P 500 ETF composition, it's heavily weighted into Google, Microsoft,
Tesla,
FAMG. Well, Tesla aside, but the other ones, like that, Google's a great business. It's probably pretty cheap right now. Microsoft is a great business. It's probably fairly valued right now. Those sort of businesses, that's a good portfolio. It's done very well. It's likely to do very well into the future.
Do you know I was offered Google shares at the IPO, and I said no, it's too overpriced.
You should have taken it.
For the record, it was $60 a share at the IPO. For the
I think
record,
it was 80, wasn't it? Wasn't it 80?
I think it went public. I think it ended up going at 80, but it was the IPO was 60. And I think you might be right though, but I thought it was 60 as a shares. And I literally to this day remember that it was my brokerage house said, "Hey, you're a client. We can offer you 1,000 shares for $60." I said, "No, it's probably overpriced. All IPOs are," which by the way is true. However, who knew you were going to say I was going to say no to Google, the biggest money maker of the world as of now. But go ahead.
Well, when I remember it going public very well because I was practicing law in Australia when it happened, and I didn't know any. In order to look at the prospectus, well, I knew that they were going public via this reverse Dutch auction, which was a very unusual way to go public, which means that the person who you basically bid the highest amount that you want for the certain amount of shares that you want, and then they fill everybody, and so then not everybody gets filled at the highest amount, so they go down until they fill everybody at X dollars, right? At $60. You could bid 1,000 shares at $80, and I could bid 1,000 shares at $60. And if the market clears at $60, then you get your fill at $60. So that's the way a reverse Dutch auction works.
Oh, maybe I'm wrong about what I was offered. Maybe I was offered an opportunity to bid on it then.
Well, it's possible that's right. I don't know exactly how the mechanism worked because I couldn't actually take advantage of it being in Australia.
Oh, okay.
In order to even look at the documents, you needed to know a postcode in the States, and the only one that I knew was Beverly Hills 90210. So I put in 90210 to have a look, but I just couldn't. Like it's too long ago. It was too hard for Australians to invest in US IPOs at the time. So I missed out, but I've watched it ever since because I always thought it was an interesting business and I thought it was an interesting way to go public. I've never taken advantage of it because even though I think it's been cheap on occasion, I've always thought there were cheaper opportunities around, much to my disappointment.
Of course. And by the way, it's funny you mentioned that. So I just sold some puts the other day at $17.50 on Google to acquire some shares, but I think based on fair value, it's probably about where it should be right now. And I know you haven't looked at Microsoft. I still think Microsoft is pricey at $260. What the heck do I know? I also thought Tesla was expensive at what's now equivalent to $50. So, who knows what I know? But so it's funny, and not to shift too much, I always, Warren Buffett's the god, but I always disagreed with his mantra of it's better to buy a great business at a fair price than a fair business at a great price. Mm-hmm. I actually disagree with that. I think based on the capital he has, he is correct. But based on the average investor, I vehemently disagree. I think you're much better off buying a fair or bad business at a phenomenal price than buying a fabulous business at I just don't agree with that. What's your opinion on that, Tobias? I think I know your answer, but please.
Well, I've written about it in the books that statistically, you are better off getting the fair business at a wonderful price. But let's talk about why that is. Your objective as an investor is not to buy the best business in the market, and that's been completely forgotten for the last 5 years at least. Because I've watched people invest in this market, and I don't argue with anybody on Twitter, but I see the comments on the stuff that I put out, where people say, it's a terrible business. They look at my portfolio. You guys know I run two public funds. One is ZIG. That's the ticker ZIG. It's an ETF that anybody can invest in.
Oh,
and it's a long only fund, and it holds what I think are the best risk-adjusted opportunities in the market, where the risk of a donut, where the risk of a total loss of capital is as remote as it can possibly be. So that's my approach to it. So first of all, I eliminate everything where there's a risk of a total loss of capital. And then I look at what remains. And what remains, I try to create a portfolio with the best risk-adjusted returns available. And so that process, it takes a long time for that to show why that's a worthwhile approach. But I do think that while I didn't participate on the way up, I haven't participated on the way down either. And I think that we're now starting to see a little bit of outperformance just basically since September 2019. I'm forgetting where I am, forgetting what decade it is. Value has definitely started outperforming now. And I think value continues to outperform. That is the usual experience in the market is that value does tend to outperform over longer periods of time. And these paroxysms of growth outperformance are typically short and sharp. There are 5 or 6 of them in the data going back to sort of 1950. 2000 was, or the late 1990s was the last one. We've seen one now. There are others when you go back earlier than that. You know, the electronics boom, where everything,
of course,
if anything, had tronics. The conglomerate boom, you know, all of those sort of things had the same experience where people just, they love the narrative and they ignore the underlying fundamentals. And if anything defines me as an investor, it's that I completely ignore the narrative and I only look at the financial statements. I don't really care what management has to say, because I think that the way you get to become CEO of these companies is you're really good looking, charismatic, well-dressed.
Tobias, I got to interrupt you. I got to interrupt you. Seth is looking at me like, oh my God, because this is something that I fundamentally...
Paul gets critiqued all the time when these other YouTube gurus say that you
not only
need
that,
to know...
Warren Buffett and Gary, the guy I believe in,
yeah,
Gary believes in management. And I sit there and say, they're good schmoozers and politicians. They're going to tell you exactly what you want to hear. Cut the BS. The numbers will show me what they're actually doing. I get it. Right. You want ethical management. I get that. But I feel like when we go to qualitative things, it's kind of a... You can't argue if cash flow is going up and multiples are 15 times. There's no, well, I think multiples are 17. No, literally the company made $1 billion on 15 billion, you know what I mean? A $15 billion market cap. The ratio is 15. With qualitative aspects, it's like, I mean, management team, I can't go possibly interview every single person in management and then say, hey, between you and me, is this a shit business or are we in a good thing? And they're not going to say to me, oh, thank you. We're off the record, right? Like, it's like, come on, you're not going to tell me exactly. And I know it's something I disagree. Everybody, YouTubers, as well as even the biggest, and that's what I was talking about. I talk about getting your own process. My process is I don't care about the management team. I will see the management team. I'd rather buy a business so cheap. And the funny part is Warren Buffett talks about management, but yet his major quote is, we buy a business that an idiot can run because eventually an idiot will run it. So I sit there and think to myself, so wait, you say you care about management, but then you acknowledge that there's going to be idiots running this company at some point. Are you going to sell it suddenly? Like, no, you're still going to keep a good business model with a moat because someday an idiot will run it. That's just and I'm sorry to interrupt you, but it's funny because my process has been, I don't care about management. Paul, did you see the CEO? He's a real charismatic guy. I'm like, great. So he's a good womanizer. I'm happy for him. I don't care. What I care about is how's he allocating the capital of the business? Let me see that. And I'll see that in the plans they have for the company. So sorry to interrupt, but I really wanted to say that the second you said that.
No, I couldn't agree more. And, Graham knew this as well. You can go back and you can read security analysis and Graham calls it double
snooze.
He says, you can listen to what they're saying and, regard them as being high quality sort of managers, or you can just go and look at what the financial statements are telling you that they're doing. And you might find that the two align. So then it's double counting. Like what additional help has the qualitative assessment given you? I understand what Buffett's talking about though. What Buffett is saying is that there are levers that management can pull that can hurt value and can help value.
Absolutely.
Outside the performance of the business. I want them, when the business gets cheap, I want them buying back stock. When the business is expensive, I don't mind if they do an acquisition with stock or if they issue some stock. That's all fine. It's issuing stock when the business is undervalued. That is sort of an unforgivable sin. And there's other things.
And buying stock back when it's really high.
Overvalued, yeah.
Yes, absolutely. All of those things, they need to be. And this is one of the problems with, so I have a small cap fund as well called Deep, which is, small and micro. The ticker's DEEP. The problem with the small and micro stuff is a lot of these entrepreneur type, not that there's anything, often owner operators are the best kind of CEOs, but where they're entrepreneurs or they've been engineers or something like that, and they haven't been fully apprised of the value of learning how to value their company and control the balance sheet and control their capital structure. And so a lot of what activists do at that level is to go in and say, hey, if you guys, you're really undervalued, you've got a whole lot of cash in your balance sheet, you're earning you've got great cash flows, like buy back some stock here. That shows that A, you can do it, you've got the financial wherewithal to do it. 2, you're aware of your valuation and you're sort of taking advantage of it and helping out the shareholders. And when they do that, I think that's a very powerful signal. So that's
100%.
That's a great qualitative management. And all Buffett is saying is that you can get these guys in who pay themselves too much and don't follow those rules. And they really can make
Fair
it harder
enough.
for the shareholder to participate.
Fair enough. And you're probably right on that one. I just, everybody sits there and talks about these honorable people. I'm like, there's a lot of stories about these CEOs out there. I don't know how many of them are really honorable, whatever. My thing is exactly what you said, so we have 8 pillars in our stock analysis, and one of them is buying back shares. And I'll have some people reach out to me in our platform and say, Paul, this company's buying back shares. I'm like, yeah, they're buying back 150 PE and 170 price to free cash flow shares. I don't like that. And then when I see them overprice issuing shares, I always say, listen, I don't like them issuing shares, but if they're going to issue shares, now's the time to do it. I get why they did that. But, it's funny because there was a book called The Outliers, I think it was, and they talk about the best CEOs, and the best ones are the capital allocators. The good capital allocators are the ones that are buying back shares when stocks are cheap. They're reinvesting back at high returns, and they're issuing shares and not doing anything, and buying and doing other things like paying out dividends when the stock is expensive. Okay, I'm fine with that, and that's what I like about the acquirers multiple and the magic formula is we've all seen that and I'm sure you'll attest to this right now, or maybe you won't. I don't know. When we get our minds into more subjective areas, returns start to fall. Because then we have to start justifying things as opposed to, just be blind about it. Listen, there are two, I've always found, so when you back test things, and I haven't gone back as far as you, I've always used the Bloomberg terminal. You back test 25 years. The more and more metrics I add, the worse and worse the returns do. They still tend to beat the market as long as they're value metrics. But if you stick around 2, 3, or 4 value metrics, you're going to do quite well. You're going to beat the market by 4, 5, 6% if you just blindly follow these 3 or 4 value metrics. What do you think?
Simplicity is its own sophistication.
Absolutely.
You really have to know what you're doing to carve it back to the handful of things that really work. And I think that I might be taking an extreme example by kicking out return on invested capital like that. I'm using that. I use the acquirers multiple and those books to sort of illustrate to people who aren't necessarily stock market people. I say that at the front of the book, my family aren't stock market people. They're smart people, but they're not in the stock market. If I said EBITDA, they don't know what that is. They don't know what that means.
Of course not.
So I have to find a way to articulate for them what I do in a way that they can understand, and then they trust the process. They understand the process, and so the process is we're not trying to buy the best stuff in the market. I do acknowledge that earning more on assets is ideal, but I want them to earn more on assets after I own them, not before I own them. When I own them, I want them to be increasing the amount of money that they earn on assets, and I want them to be doing it at a price that allows me to participate at least as well as the business does. If the business, and this is something that people who haven't been around in the markets for a long time, or if you've only been in the market for the last decade, you missed the decade before then. There are a lot of lessons in that decade before them about excess. And one of them was, we all remember the dot-com boom as being a dot-com boom, but it was also characterized by very good, very big businesses becoming exceptionally expensive. And you can think about Microsoft was one, Walmart was one, GE was one. They were all too expensive. And even though for that following decade, they had spectacular returns on invested capital and spectacular growth rates in earnings and revenue, the stocks did nothing for 15 years because they were too expensive and they had to catch up to their valuation. So you can have a really good business that performs really well and the stock price does nothing because it's too expensive. You need to be investing at a level that allows you to participate along with the success of the business. And that's all I'm trying to do, trying to find businesses that will survive. That's the first thing that I want. So that eliminates too much debt, business models that are
What's too much debt to you? If you could break down debt in the simplest form, because there's a sophistication of simplicity. And by the way, it always depends. The question becomes, one thing I look at is I take the 5-year average free cash flow and I want their total long-term liabilities to be under 5 times that amount. That's kind of, and I'm not saying that's the right number. What I'm saying is if I bought 50 companies like that, I'm probably going to do okay. Now, does that mean that, go ahead.
I just think I love Charlie Munger's got the best response. He says, we want companies with little to no debt. And somebody in the audience says, what do you mean by that? And he said, what don't you understand about no debt? And that's kind of the way I think about it too. I have stuff in the portfolio that does have debt that. So I own Domino's. Domino's, I bought that recently. I think that Domino's has way too much debt for what I would like that business to have. But Domino's is this unusual business that it's a franchise business that has this massive distribution. People love it. We eat it at home. And
Domino's thin crust is the best.
And it's the cheapest way to feed a family of 5 of all of the sort of QSR type options that are out there. It's the cheapest way of feeding a family of 5. So no matter what happens through this next period of time, I'm pretty confident that Domino's is going to make it to the other side. They earn massive amounts of money on what they've got invested in them. They've got some debt because they've been buying back stock because it's too cheap. They're gushing cash flow. That's the kind of thing that I like, but that's at the sort of outer limit of what I would regard as it's probably too much debt.
So let me, I want to look at, and by the way, one of the things I want to do is I want to look up Domino's in our app and see what the debt level is. So let's go to our 8 pillars and let's see this. So the average free cash flow is about $400 million over the last 5 years, 8 pillars. And their debt is 13 times their average free cash flow the last 5 years. So it's consistent with, that's a big number. 13 times their 5-year free cash flow. Okay. So for us, I look at our 8 pillars here, Tobias, and that apart from valuation, that's their only other X. So right now their valuation seems rich apart from, and then you look at the debt, it's like, okay. And by the way, for me, that probably would have been like 13 times for that kind of business. I don't know. I'm not saying I'm right or wrong. I would immediately be a red flag to me going, man, 13's a lot.
Well, I raise it as as the absolute outer limit of, and it was one of the ones that I looked at when I put it in, and I thought this is probably on the edge, but I don't think that it's an issue for Domino's. Like, do I actually think that debt is becoming an issue for Domino's? No, I don't. But it's 100% like that. If anybody goes through the portfolio and they see Domino's and they're like, gee, that's a lot of debt for this, I would agree. That's a lot of debt. I just think it's going to be okay.
Okay, great. Listen, that's the thing that's the art of investing that I think a lot of people don't necessarily, so I've had people say to me, Paul, what's this about? Like, listen, if you just want a tried and true, do this, acquires multiple magic formula. But if you want to get into the art of investing, that's exactly what Tobias is talking about here. Like, if it was any other company 13 times, or 13 times, that's a lot. But for Domino's, all right, it's a franchise model, probably a pretty good gross margin, okay, I'm okay with this. And that's the other thing. We're not talking about, a car company with 4% bottom line profit margin and 13, that's somewhere I go, whoa, time out, let's pump the brakes here. But we're talking about a reasonably margined business, and that's part of the art of investing I tell people about. And I think one of the things that I love about Acquirers Multiple is it just dumbs it down into the simplest form.
I was just going to say the same thing, Tobias. This book spoke to me as a more normal person, just in its ease. It's a 3-hour read. I listened to it on Audible while I was painting a bedroom. But, one of the things that really spoke to me, Paul, which we don't talk about that often, and I bring this up, Tobias, William Green says hello. I know you guys are hanging out. I saw each other at the Berkshire meeting. He says hello. But I love him because the way he did. He's sort of the normal person mouth for all these crazy mathematical equations. But the concept of mean reversion is something you don't mention that often, but you did really well in this book. Can you just tell our viewers in the simplest sense, because a lot of people wonder, how does value investing work in the long run when I'm buying these boring, stupid companies and not these high flyers?
Yeah, so mean reversion has a variety of different meanings. If you've done any statistics, and lots of people have it at university, but you don't have to have done statistics. But if you've done statistics, you'll understand this idea of, if you take a population, if you take a sample, you'll see that there are things that are close to the average, and there are observations that are a long way away from the average. And the idea is that as you increase the size of the sample, the things that are a long way away from the average get cancelled out by other things that are on the other side of the average. And so over time, your sample should converge to the mean of the population. That's not exactly what we're talking about here, but the idea is roughly right. The idea is that through a business cycle, there is some underlying earning power for every single business, but it's obscured by the fact that they have, so this has been a good example of the last few years that we've been through. Many businesses have over-earned through COVID because they were beneficiaries of what were an unnatural set of conditions where people were at home and so on. So they're going to look better than they actually are. They've over-earned what they would ordinarily do, and they are going to come back to their long-run mean earnings on assets, and vice versa. There are companies that have under-earned through this period of time. Energy is another good example of that. So there's a variety of different types of mean reversion that you need to be aware of. One of them is that business level mean reversion, which is that companies will over earn and under earn through their business cycle. And the other one is the market's overreaction or underreaction to those earnings. So
the pendulum.
Businesses, right, but it's also it's more complicated because it's like a pendulum with a pendulum attached to the top of it. And as you know, if you've ever seen those little diagrams on the internet of the pendulum, it becomes this sort of chaotic movement, and it's very, very confusing. But what happens is at the top of the cycle, when earnings have been rushing up, the multiple will be at its absolute peak, and that's you would look back 5 years and you'd say, well, the earnings have gone up 30% a year. The stock price has gone up, 35% a year. If the earnings keep on going along in this trajectory and the multiple keeps on expanding, then this is going to be a very profitable investment. But what tends to happen is that invites in competition, the earnings come back down, the multiple compresses more than the earnings, and so you get punished more than the business gets punished as an investor. But you can enjoy that on the other side too. The difficulty is that you have to buy these things that have had earnings shrinking over a period of time. And I've got lots of little studies in the book that show that this is actually the case. If you want to buy, it's completely counterintuitive, but if you want to buy high earnings growth, the place to find it is in things that have had bad earnings growth but have survived for a long period of time, because the other competitors in the industry, they tend to leave. There's nobody there. There's no capital in the industry. So when that industry gets its cycle again, they see this explosion in earnings, and then they get this massive re-rating because they've gone from being undervalued on a low multiple to being closer to what they earn on average, and the multiple responds as it kind of whips the other way, and so you get the cheap stuff generates the highest earnings growth. It makes no sense. It's completely counterintuitive, but there's no reason why something that is cheap on a multiple basis should indicate higher earnings growth in the future, but it tends to.
So it's funny. So let me, Tobias, humor me for a second, just without saying, well, this is a kind of an ongoing joke in the channel. If you were to see Tesla,
as soon as he was talking, that's what I'm thinking.
So,
as I was reading the book, I'm thinking Tesla.
Let's think 10 years from now, and Tesla is the number one car maker in the world, and they make 10 million cars. Give me a long-term average PE for Tesla. What would you sit there and say, listen, I'm just going to sit there and this is my long-term average PE for Tesla 10 years from now. What would I assign Tesla doing $1 trillion a year in revenue? What would I assign them as a PE?
The problem with Tesla, and I've got a long answer for Tesla because at one stage Zig was long short, and so I have been short Tesla on occasion, and I've made money on occasion and lost money on occasion, and so I think I've net washed out on it. I missed the most recent gigantic run up because of some of the risk factors that I have in there, but I could give you a thesis on Tesla, but I'll give you the short version is it's a metal bender, and it earns low margins on the metal that it bends, and that's like every other car company out there, and so it doesn't deserve a very high multiple because
it's not a software. Wait a second. It's not a software business.
It's one of those things that people like Paul, you and I are going to look at those financial statements and ignore all of the narrative and ignore the genius on the top and say, I don't get it. And then there are people out there who are saying, can't you see that this guy's putting cars into space and putting electrodes into brains and like, what don't you get about this? Like, this is
and what I heard recently from Mr. Wonderful from Shark Tank, who I think is an absolute moron, but the recent video I saw on the internet was Tesla's a data company. This kid was telling me what I was missing, and as soon as he told me that, I was like, I get it. It's a data company. And I'm like, oh my Lord. I'm like, what are we doing here? Guys, they make cars. They make cars. By the way, the reason I bring this up is there's another person on the internet who made fun of me for comparing Tesla to Ford. And they assigned a 70 PE ratio to Tesla 10 years from now, doing what he considered was $3 trillion a year in revenue. And he thought a conservative PE was 70, not 17, 70. And I remember thinking to myself, this is the world we live in right now. And the pendulum has swung. The one pendulum has swung all the way over here, where 70 PE is considered completely rational for a company that does $3 trillion a year in revenue. Not $3 trillion market value, $3 trillion per year in revenue. And I was like, Okay. And
I'll
go
make
ahead.
a prediction for you.
Yes, let's hear it.
If generating revenues like that, it still won't be earning enough on its assets to justify, that kind of multiple. The thing
It
about
will
Tesla,
be? It will not be, or will be?
No.
Oh, exactly. Of course me.
That's the way I would have said. I don't really care how fast it's growing. I just care what it's earning on its assets or what it can earn in
Oh, that's interesting.
some sort of ideal state. Like that's how you value it. That's a valuation. It's worth what it earns on its assets if it earns. So your fallback position is the 10-year. If it's earning 3 times the 10-year, then appropriately adjusted for risk, it's worth roughly 3 times the 10-year on its assets, and that's how you do a valuation. And if it pays that out, if it pays it all out, then it's worth a little bit less. If it reinvests it at those higher rates, then it's worth a little bit more. It's not a very complicated process to value these things. But as Buffett and Graham have both pointed out, the problem with these businesses is when they're loved like this, they can take advantage of that overvaluation and they can raise a whole lot of capital. And so that can break your short thesis a little bit. So I've found that the best approach with Tesla, for the most part, is just to ignore it. I'm like you. I've gone in and done little valuations on it. My valuations are embarrassingly low. I've shared them a few times.
No, I'll tell you mine. I'll tell you mine. Mine right now, as of this very second, I have it from a value perspective. Like I'm sitting there saying, where would I start buying? $60 to $80 a share. Now, do I think that's what it's worth? No, I think it's worth probably low 100s. But for me to enter it, 60 to 80. What did you just say about what I said?
Oh, sorry. Yeah, on the most optimistic assessment. So I agree with you. Like I do an optimistic assessment, and I can't get. I can get an optimistic valuation of 200. That doesn't mean I'm going to buy it at 200.
Exactly.
I want a big discount. I want $130, say, for 200. But that's my optimistic assessment. Like, if it actually trades down to there, and I'm going to start thinking about it properly, then I'm going to go and take a conservative estimate of it, and then I'm going to try and buy at a discount to a conservative estimate, because that's what I do. I'm not trying to justify. I don't go looking for things to invest in and then justify the price that I'm paying for them. It's the other way around. I'm looking to not buy stuff, and I'm trying to all the time. I have a portfolio, and I know roughly what the portfolio earns on its assets, and I know roughly what I'm paying for that valuation. And so this is when I talk about risk adjusted. I'm trying to get the maximum torque out of the things that I'm invested in. What do I think can earn the most on what I invest in it over the next sort of 3 to 5 years? So that's how I'm thinking about it. When you approach it from that direction, you have to be approaching from a conservative valuation first, not justifying why you're putting stuff in the portfolio.
Of course. And it's amazing, Tobias, because this is the biggest thing I've been trying to teach our viewers. And I want everybody to understand who's watched this channel over and over. You listen to Tobias, you listen to me, you listen to all the value investors. We have different approaches. Tobias is a little bit different than Greenblatt's. Greenblatt's different than, but the sayings are the same. Like Tobias, we met with Monish Pabrai, and Monish, he actually disagreed with me on Tesla. He said, I don't know if I'm exactly convinced that Tesla's massively overpriced and blah, blah, blah. But the approach of which we look at things is very, very similar. But he definitely disagrees with you on Tesla. He disagrees with you on Tesla. His comment was...
Well, it's halved since we had that conversation, so I'd be eager to learn what his thoughts are now. The stock price is halved.
Knowing him, he probably wouldn't care where it's halved to. Mm-hmm. But I remember him, he was kind of evasive. I don't think he wanted to get into the conversation exactly, Tobias, but he definitely disagreed with me. Now, we definitely disagree. We definitely agreed on cryptocurrency, right? And he said, but there's, that's the thing that's great about value investing. Even the value investors disagree with each other. There's just different approaches. The approaches and the thought process is the same. The thought process is, Paul, if Tesla grows 30% a year, I'm like, yeah, but I don't want to buy it based on their most aggressive growth potential. Right. I want to buy it based on, hey, what's a reasonable growth potential for a company that's going to sell 1 million cars this year? That is changing the car business, which I do believe Tesla has. By the way, spoiler alert, I just bought a Tesla 2 days ago, just sold it today. I did not like it at all, Seth.
Didn't like it.
I actually literally... 100%. I bought a Model X. Wow. I got it 2 days ago. I drove it and I was like, this thing sucks. I don't like it. By the way, it doesn't suck. I didn't like the new steering wheel.
No, that does suck. I agree.
It feels like I'm driving a bus. And I'm not trying to be a snob. I'm a luxury car guy in terms of the SUV. This was more like, I have a man bun. I have a beard. I have tattoos. No offense.
You look like Tobias and I.
No, Tobias does not have a man bun. Do you have a man bun, Tobias?
Well, he's close. Look at him.
Okay, good. So I sat there and said, I'm getting rid of this thing. And But guess what? I still think Elon Musk is awesome. I love him. I think the car is great. The technology is awesome. I think the car is phenomenal. I love the fact there's no haggling. This is the price, pay it or go. Great. Love it. But I just don't like okay, doesn't mean I'm a assign 40% growth in the next 10 years in the car company. I'm sorry. I just can't get around that. Just like Alibaba, it's fallen a lot. When I was making my assumption on Alibaba, I was assuming high single digit growth rates. People are like, but Paul, it's done 30% a year the last 10 years. I'm like, yeah, it also did $3 billion in revenue 10 years ago, and it's doing $120 billion now. Like this is a totally different company than it was 10 years ago. So that's one of the big things that's hard to teach is teaching people that just because they did this in the past, you have to remember they're bigger now. They're not going to do that in the future. You know what I mean? And that's the thing that is hard to get around. And it's hard to explain to people that the growth story that made the stock so high probably is not likely to carry the stock forward.
Well, this is what I love about your book too, Tobias, is it really, like I said, it sort of speaks to me as more of a normal person because I have sat here with Paul listening to this for 3 years, but I still need to be convinced. So the more books I'm reading, William Green's book, Good Stock Cheap, Good Stock's Cheap, the more I hear it, it starts validating it that it's not such a contrarian view. It's actually the best view in terms of investing. It's not value investing, it's investing. And the more I learn and then I hear stories from normal people, they kind of deep down inside, I'm thinking that they sound pretty silly right now and they don't even know it. They just haven't even heard of this style yet. So that's why I really like this book. I think it just really speaks to like normal people. The math does get confusing, but I really enjoyed it. So in the process.
Well, the idea of investing for the most part is it shouldn't be really exciting. Like the idea of it is the objective is to kind of make some money, and the way that you make money for the most part is you find stuff that is ignored and neglected and is better than it's getting credit for, and you buy it. And when you get that all I'm saying is it's better than it's getting credit for. I'm not saying it's the best thing around. It might be just treated as if it's not worth anything at all. And you're buying it cheaper. When it gets a little bit better, you sell it out and you move on to the next thing. You find better opportunities. That's why whether the exact mechanism, and I think Paul is right about this, the exact mechanism of assessing value is less relevant than your overarching approach. And your overarching approach should be first, I've got to make sure that I'm going to get my money back from this thing. It's not going to be a zero because zeros are hard to recover from. Mm-hmm. And then if you, along that same vein, the very next thought is, well, I need a margin of safety and I need a margin of error. Like that's just another way of saying it. I'm going to make sure that if all of these assumptions that I'm making don't turn out to be true, if enough of them sort of work out, then I'm still going to be able to make a little bit of money here or earn. So you should know, like the S&P 500, the average return on invested capital in the S&P 500 is 13.3%. And you should be able to look at the PE on the S&P 500, and that's a reasonably good base case. Can you get cheaper and better? And that goes in the portfolio. And I think if you look at my portfolios, so my portfolios are all publicly available. You can go to Morningstar and find Deep or Zig, and you can take a look at those portfolios, and you will see that they earn roughly what the index or the average does, or a little bit better, but they're half the price. And so what that says to me is that they're going to do roughly as well as the index from a business perspective, but they should do better than the index from a return perspective. And even if I don't quite get there on the return on invested capital, if it works out that they are, they're rightfully being sold down, I've bought them so cheaply that it shouldn't matter. I shouldn't get beaten up that badly, because my objective is to A, survive, and then B, to earn a sufficient return on capital to sort of justify the existence of the funds and the investment. And so that's my very long-term approach. And it can take 5 or 10 years for it to sort of really show its true colors.
That's awesome. We've been doing this for, this is an hour, so we don't want to take up too much of your time, but Tobias, I really encourage everybody. Can you hand me the book real quick?
Yeah, here you go, Paul.
Guys, this is a great book. I'm not just trying to plug. This is literally me listening to Seth. After I told Seth, go out there and just find people. He emailed William Green. William Green said, yeah, let's be on the show. I emailed Tobias, and I think it was like a month later or something like that. Tobias, you're like, yeah, I'll be on the show. Sounds good. Let's do this, which I appreciate very much. But he has other books out here. Guys, like Tobias says, this isn't some sexy ride along, buying these high-flying companies that are going to be, oh man, I own this, I own that. No, it's supposed to be somewhat boring, and to do best, you got to find the most boring stuff because that's probably being overlooked. And that's the whole key to what Tobias said. I'm getting about what the return on invested capital is. However, I'm paying half the price. So as the market shifts, people will see that and realize we're getting a better return on our money and therefore start to invest in it. And then the cycle will change. And all of a sudden, and by the way, just an example, when I run my back test on Bloomberg, going back 25 years from 97 to now, literally it beats the market every year from 2000 to 2010. And from 2010 to now, it's only beaten like 2 or 3 times. And most people would look at that and say, this is bad. I look at that and say, yes.
Oh, thank God.
I literally think that and go, it works. That's my indication that it works, because value investors do the best when the headwinds are strongest. That's a fact that's been proven over all the history of investing. Correct? Am I wrong, Tobias?
The best times to be value are in the drawdown. You're likely to retain a little bit more, protect a little bit more capital in the drawdown. And on the very early stages at the other side, that's sort of when you generate most of your return. And then, if you can get market perform from sort of early in the cycle through to near to the end, the sort of blow off top at the end is value guys are always going to underperform through that. One, because I think that all of the money rushes into the really high performing stuff and it runs away. And also because value investors tend to pull their horns in a little bit at that point and start protecting capital for the next sort of leg down that almost inevitably comes. We've had this very, very long period of a very bubbly boom. And so value guys have looked particularly dumb for like the last decade. And I've got a friend who has a 200-year back test at Mikhail Samanov. It's 200 years of, he says this is the worst value drawdown in the data going back to like 1825.
First off, how does he have 200-year value? I mean, how does he have a back test going back 200 years? How the heck did he find that data?
Carrier pigeons?
It's really clever. So, we've got the current databases that everybody uses go back to about 1925, 1926 for price to book value. Then there was the Cowles Commission. He used the flip cards to work out if there were any investors who had skill, and that goes back to 1875. And that's what Graham refers to when he says, I think that I could do about 15% a year using Graham's methodology. From 1875 to 1825, there was this long-term project where they went and found every kind of annual report that they could. And this was before they had to publish
Christ.
no cash flow statement. They're doing it on price to dividend because that was the only valuation metric that they could find. So the data's ugly as you go back, but it's fascinating to go back through this. And I've matched it up with all of that there was a Great Depression before the Great Depression, and the Great Depression that preceded the Great Depression was called the Great Depression, but now we know it as the Long Depression. And there are all of these things that have happened. So 1825 is the invention of the telegraph. That was the first information technology bubble in the States. And value underperformed a little bit. But over that full data set, 200 years, the outperformance is astronomical. Like you couldn't be in anything else. Value is the only place to be. You're just going to have to suffer through these periods of time where you look like an idiot. And evidently they're going for 10 years, which is a big chunk of an adult's life,
So while I'm looking like a dummy, Tobias, and for our viewers at home, I'm in the magic formula, Paul. Would you suggest that perhaps my sell-off date is July? I know that the acquirer's multiple, Tobias, is I'm buying a little more actively than once a year. So what Tobias said, someone switches?
Well, what Tobias said was, if you're okay with volatility,
which I'm fine.
Okay, then I think that maybe based on his data, and the thing that's interesting, Tobias, is I've tried to look for other reports that people backtesting the little book, The Magic Formula, and nobody can really replicate it. So my final question to you was going to be, can you give us the very simple, how do I do the acquirer's multiple? That way somebody can either backtest it or do it themselves, because, in little book, he gets upwards of 30% returns a year based on some metrics, but every single article I read, everybody's like, well, I couldn't exactly replicate that. So can you expand on that a little bit, since you have data going back to, Jesus Christ?
In quantitative value, we tested the magic formula using the academic gold standard point-in-time data. And the significance of that is that if a company goes bankrupt, you will buy it, and then the bankruptcy will impact your returns. And that's the question I always get asked. That point-in-time data starts in 1963. So from 1963 to when we published the book in 2011, Magic Formula most certainly outperforms through that full period. Whether it generates the returns that, when Greenblatt published that book, he did that in 2003. I think he used data from like 1996, or he used 12 years.
I think it was 88 to 2000. Yeah.
So
I think,
as we know, as we now know, now that backtesting is sort of ubiquitous, that definitely you're going to get variation in returns. And he may have used a small data set. We do other things, like we limit the liquidity of the portfolio. We do a whole lot of other things to sort of try to get as real as we possibly can. And even with all of those constraints, and the magic formula does outperform. The acquirer's multiple does a little bit better. But, since the book came out, the acquirer's multiple has underperformed the magic formula a little bit. And so I suspect that they're much closer together than they were historically. I would say that we're probably closer to the end of the magic formula's outperformance, and it'll probably just be a raw value outperformance for the next decade. And then it moves around quite a lot is the true answer. So it doesn't really matter which you choose. You just want to be in one of them and probably stick to it as much as you can. I have a website where we publish. You can go and look at a free screen. Acquirersmultiple.com has all of the names. I pre-screen out all of the stuff that fails on all of the fundamental stuff that I was discussing before, all the credit criteria. You might find that there's international stocks there. You can kick out the international stocks. There's all of these different approaches that you can do that make you comfortable, because that's the key. You just have to be able to stick with it through thick and thin. Whatever you do,
don't deviate. So Seth, it's funny. Seth's when a family member of Seth went to the magic formula and 2 months later said, "This thing sucks. I'm leaving it." 2 months. And I'm not trying to pick on them, but go ahead.
You have to believe in it. You have to understand. That's what the most important thing is, understanding the logic that underlies it. And that makes it, so even though the last 5 years sucked and I underperformed, I understood all the reasons why it was underperforming. So it was no great issue for me at all. I mean, it's still painful. I don't like.
See, I don't consider it painful. I don't think it pain. I mean, maybe I'm fortunate. Maybe I'm a sociopath. I have no idea, but I just didn't look at it. I had no pain from it. I just thought, okay, it just means my future's going to be even better. Because I really do. It's funny. Somebody recently in a comment said, "Paul, check yourself. This is not a worse market than 2000. I'm like, yeah, it is. I mean, it is a more overvalued market than 2000. I'm sorry. I mean, Tobias, do you agree with that, or am I just kooky tunes here?
No, objectively, that's the case. If you look at price to sales or any of these other, it's complicated because you have margins expand and contract too. And when margins are very, very wide right now, unusually wide, have stayed unusually wide for an unusually extended period of time. And we're peak price to sales. So there's going to be a reckoning here, and it's going to be really ugly. It's going to be a 2000 and a 2007 mashed together. It's going to be nasty. We're like 20% into it. I think that before it's all said and done, we're probably 50%-ish down. And, there's not going to be any...
Oh, that's not even ugly to me. That's not even ugly to me. 50% to me isn't ugly. I know it sounds crazy.
The true answer is, who knows? Like, it's not like it stops at fair value. It doesn't bounce.
Well, that's what I always tell people. Yeah.
Go ahead. It was like a golf ball off a concrete path in 2009. It's not going to happen. I mean, who knows? Nobody knows what's going to happen. This might not be it. We could run back up. It's going to happen in the future. At some point, you need to get that market clearing where we get back to sort of normal valuations, and then, then we'll have another boom. That's just what happens. You have booms and busts. Last
June, I played golf. And the caddy said, "I recognize you. You're on that Everything Money channel." I said, "Yeah." He goes, "You're wrong on Bitcoin, Tesla, and Palantir." I said, "Okay." So I always reference him. I'm like, if your 18-year-old golf caddy tells you you're wrong about something, you're probably right. You might be early, but your 18-year-old golf caddy who just graduated high school and just got his puberty, just went through puberty, probably has no idea what value is. And you look at Palantir, Bitcoin, and Tesla since then, and it's struggled. Now, do I think it's even close to the end? I do not. I just think, and I people ask me, where do you think the S&P stops at? I said, listen, all I know is what Tobias just said. We're not going to go to fair value. The pendulum has to swing. People have to give up on stocks. They have to sit there and say, you are stupid for owning stocks. We're not going to get there with the 10-year PE at 15. We're probably going to have to get to single digits like every other secular bear market ends in history. And that involves, I tell people, the 1982 bear market, the equivalent of today to get to the 1982 low would be 650 on the S&P. Does that mean we have to get there? No. But I'm sitting there saying, like, this is like a bear market. Like in 1982, with high inflation, high interest rates, you were hard pressed to find anybody who wanted stocks. That's why they sold so cheap. And in 2000, when everybody said you were dumb for owning Intel and Cisco, and the example I always give in my videos, Tobias, is I always pull up that chart and say, look at the stocks here. If I told you in 2000 that their revenue and profit would triple, each of them, where would the stock go? And the stocks are still low, still below that peak. I go, that's what we mean by when you can overpay for a good thing. I literally said the profits triple, the revenue is triple, and the stocks still have not gotten that previous peak. Because if you overpay for a good thing, it will hurt you. So listen, I have no problem telling people my personal opinion is, and it's gotten higher. 5 years ago, I thought the market would go to 1,100, 1,200. Now I'm at 1,500 to 1,800 the S&P. I just sit there and say, listen, I know it sounds detrimental. And if this goes longer, the number will keep going up because fundamentals get better. But at the end of the day, we have margins that are very, very high right now. That's the only thing that makes the 10-year PE lower than 2,000 right now is because how big our margins are compared to history. Other than that, every reliable metric says that we're way more overvalued than 2,000. Every single one.
It all mean reverts over time. It just takes much longer than everybody thinks. And I always point out in relation to the big busts, March 2020 may have taught everybody exactly the wrong lesson, which was to aggressively buy at the very wrong time because it was still expensive when it bounced. When you look at, go back and have a look at what happened in 2007 and 2009. It's not the big drawdowns that kill you. It's the rallies that you have these 14 or 15 rallies, and have a look at how big those rallies are. They're like 20, 25% rallies. It's hard not to think that it's over at that point. And then you put all of your money in. At some point, it's inevitable. You can't not do it. And then you've got only 7 or 8 of these lower lows to go over like 6 or 7 months. It's sickening. So you just have to get your mind right now. This is what I'm going to do. I'm going to buy stuff cheap and it's going to fall, and I'm going to find a better opportunity that's cheaper, and I'm going to sell something that I thought was cheap a month ago because I found a better opportunity. So I'm selling lower. That's my mindset going into this. I'm going to make a lot of mistakes, going to keep on buying and selling until at some point the market will rally sustainably, but that could be 18 months away, and it could be a long
5 years away.
Yeah.
Could be.
Tobias, thanks so much.
Yeah, this has been incredible. I'm sure our fans are going to eat this up. And if you haven't gotten the book, Acquires Multiple, make sure you check it out. There will be a lot of discussions in our little book chats in our community. But Tobias, we'd love to have you on in the future, of course. And I have deep plans to go down to Berkshire next year. Hopefully I can see you.
You're going to go?
I'd like to maybe take my son out there and just show him what it's like. Yeah, I'm not going. You said that, but
there's no chance I'm going.
Yeah, maybe. So, but again, Tobias, we'd love to have you on in the future. Thank you so much. We'll follow. I just subscribed to your podcast. I'll be watching, and we can't wait to have you on again. Thanks so much. Appreciate it.
Thanks, gents. I'd love to come back. My 2 funds are Zig and Deep. My Twitter is greenbacked, and the book is Acquires Multiple. I've got some other ones out there too. I'm always available. Love to chat about it.
Awesome. Thanks.
Thanks.
See you.